Despite stocks erasing those losses from Monday's sell-off, my next guest says markets are heading for an unavoidable risk-off episode, especially if the Fed starts tapering. For more, let's bring in Barry Knapp. He's managing partner and director of research at Ironsides Macroeconomics. Barry, it's great to have you back. You're generally bullish, I guess you would call it, on the markets, but you've kind of changed your tune a little bit over the past few months. What do you see of concern?
Yeah, that's correct. I mean, we were unabashedly bullish from the lows, and I assumed that any corrections this year, based on sentiment, would be limited to 4 to 6% or so, until and unless we reach the point where the Fed started normalizing monetary policy. Now, this pattern has existed since World War II. Generally, there was one correction every business cycle when the Fed achieved enough confidence or had enough confidence in the economy to start normalizing policy. But back in the days of rate policy, that was generally limited to about an 8% correction. After the global financial crisis and the emergence, those corrections got larger, more like 12 to 13%. And it really is the role of risk and mortgage purchases in particular that really causes those corrections to be greater than they would have been otherwise. Specifically, what I'm getting at here is that when the Fed buys mortgage-backed securities and doesn't hedge prepayment risk, that suppresses volatility in the fixed income market, and that permeates out through the system. When they stop buying mortgages, the mortgage desk of Barclays, where I used to work, or Solomon, or Goldman Sachs or Morgan Stanley, suddenly has to take down that prepayment risk. Right now, with rates having rallied so sharply, typically you would have had interest rate volatility rising, not falling. And so when this risk transfer happens, that permeates out through the system from broker-dealers through hedge funds and causes a big risk-off shock. Even if we don't get the announcement next week that they're ready to taper asset purchases, there was a very good survey by Morning Consult that I saw late last week that some 70% of recipients of unemployment insurance have their benefits expiring by the end of August. To me, given the decline we're seeing in emergency employment beneficiaries, unemployment insurance beneficiaries, we're likely to have two very strong payroll reports by the time we get to September. That will qualify for making substantial progress towards their goals. We've already achieved it on the inflation front, and they'll start tapering asset purchases, and we will have one of these volatility risk-off shocks that will probably be greater than 10%, but that will mark the transition to mid-cycle. So it's an important inflection point, but it will be a risk-off shock, and it's totally unavoidable.
So let's talk about how people you think should be positioned for this. You're telling them to reduce their small cap exposure, cut risk to industrials, materials, and emerging market equities, reduce a little bit on industrials and semis. Where does that leave them adding cash?
Well, they shouldn't be adding anything right now. In my opinion, you should be, protecting your capital, because other than having bought at the lows, these are the best windows of opportunity to add money to the market through the business cycle. If you recall, the sell-off after QE1, the flash crash, QE2, when we had the debt ceiling debate and downgrade, was an excellent entry point for the market. So these really are your opportunities. If you're already cautiously positioned, don't worry about it, because these are 2-month transitory events. The market rebounds even faster than it goes down, and we move on our merry way. The Fed is not going to derail the recovery. This is not going to negatively impact growth or the earnings outlook. It's a risk-off volatility shock.
Barry, one quick metaphysical question I want to ask you, because people are asking it about the pandemic right now, and they're saying, okay, even if we have Delta, even if there's an adverse economic reaction, we know from history that we have a strong rebound to follow. In the taper that you're describing, you're talking about an adverse market reaction followed by a strong rebound. So why wouldn't the market just pull forward the rebound and not actually have the sell-off in both cases?
Because of this transfer of risk. I mean, one of the most insidious things that QE does is it suppresses interest rate risk. And, there's all sorts of effects that come out of that. There's the suppression of creative destruction, companies getting financing that shouldn't do otherwise, and investors taking more risk than they would have otherwise. So as that risk gets transferred from the government, who's not hedging it, to the private sector that needs to hedge it, that causes a volatility shock. That's the part that I'm saying is unavoidable. This is not about expectations. This is about all of a sudden Barclays mortgage desk has a whole bunch of risk that they didn't have before. They tell the equity derivative desk to cut the risk, the credit desk to cut the risk. Next thing you know, it permeates out to hedge funds, and that's how these risk-off shocks occur.
Well, that's why it's fun talking to you, because you do have that inside perspective of how, what's playing out in real time. Barry, appreciate your guidance today. Thanks.
Shepard Smith here. Thanks for watching CNBC on YouTube.